how to calculate the profit of an investment property with a simple formula. In today's video, I'm going to teach you how you can, in less than 10 minutes, calculate exactly whether or not this deal is right for you. Thank you very much for tuning in. My name is Rajat Tayyeb, broker owner of Fit Realty Services here in New York City. So the purpose of this channel is to provide real estate relevant, valuable information. So without any further ado, let's dive into the video regarding our investment formula. So it goes like this, right? Because you always want to remember. So what we created is poor wins, eats nasty, dry cake. I mean, you're asking yourself what it has to do with the investment formula, just for us to remember, right? So poor wins, eats nasty, dry cake. So the P stands for potential gross income, PGI, right? That's your poor. The wins, it's your vacancy, because any property out there, you're gonna have vacancy. You're not gonna have a full occupancy at 24/7, right? There's always gonna be vacancy. So that stands for wins, right? Eats, it's actually effective gross income, EGI, right? So we got poor, wins, eats, right? Alt is very important. Alt is very important. Alt stands for operating expenses, OPX. Very, very important to be very clear on your operating expenses. And we break them into two. We break them into fixed and variable, right? So the fixed, they does not change with the occupancy of the building, right? That'd be your property taxes, that's gonna be your insurance, right? Your variable operating expenses, it's gonna be your heating bill, your water bill, your gas bill, maybe you have a managing agent, maybe you have a trash being taken out, right? So they vary on the occupancy. So that stands for the OPX. Now we have a dry, right? Debt service. Unless the property is paid off and you don't have a mortgage, then you can scratch the DS, right? The dry. But if you do have a mortgage, you have your debt service. You have your monthly payments that goes back to the bank. So you obviously have to take those in consideration. So that stands for dry DS, debt service. Then next one, we have nasty. Nasty, it's your net operating income, right? So that's your income, that's basically your effective gross income minus your operating expenses. That gives you your net operating income, right? And then from the net operating income, you take down the debt services. And finally, the cake, right? Everybody likes cake. So the cake stands for cash flow before taxes, CFBT, perfect. So we've got the basic formula, right? Poor wins, eats old, nasty, dry cake. You have it in a nutshell. Now, I'm gonna show you how can you calculate an actual return on investment, cash on cash return investment on a property. Because it's very important before you even go out there and you look at home, have this simple formula in place to see whether or not this is even worth for you to go out there and look at the property, right? So let's get to it. I'm gonna give you an example of a property here in New York City. For instance, let's say you buy a 3-family home. The property is $900,000. So you purchase it for $900,000. Number two, the rental income is, let's say, $2,200 a unit, right? So that gives you a monthly income of $6,600. Now we always look at it yearly. So you take the $6,600, you multiply that by 12, and that gives you $79,200 in your yearly income. But keep in mind, this is PGI, potential gross income, right? You're gonna have vacancy. You're not gonna have all 3 units rented for 12 months out of the year. You might 1 year or 2, but there's definitely gonna be vacancy along the way. So what we like to do, we always like to use a 5% vacancy of the PGI, of the potential gross income. So if I take 5% off the $79,200, that gives me $3,960. So that gives you the effective gross income. So now you're at $75,240. We took the potential gross income, we subtract the vacancy, which is 5%, and that gives you the effective gross income at $75,240. Next, which is going to be always a little more complex to calculate, is the operating expenses. And remember, we got the fixed and we got the variable, right? I go by percentage. I always like to have a percentage somewhere between 20 to 25%. So for this scenario, for this example, for this formula, I'm going to be using a fixed property taxes of $7,000. I look up a property, $900,000, 3-family, taxes of $7,000, and you're going to have your homeowner's insurance of about $1,200, right? So that's $8,200 right there. You're gonna have your variable expenses as water. I put the water at $1,200 a year. You're gonna have your gas bill, your heating bill, about $2,400. You're gonna have your repairs. You always have to have some money for maintenance. Little cosmetic, little leaks here and there, $2,400 a year. And you've got your total operating expenses at $14,200. So between the fixed and the variable, it's about $14,200 in expenses. So now we had to figure out the operating expense ratio. Again, it will be about 20 to 25%. In this case, it's a little below 20%. Now, once we take the effective gross income and we subtract the operating expenses, we get down to something called a net operating income. So your net operating income in this case would be $61,040. Next, we're gonna figure out that you had financed the property, so debt service. And again, I'm gonna go through a very simple math. So let's say you purchased the property for $900, you put down 25%, which on average, when you're buying an investment property, you gotta have 25% down payment, and it would be $225,000. Therefore, your loan amount will be $675,000. If you finance that at 4% interest rate, that's gonna give you a monthly payments of $3,223. Again, we've got to multiply by 12 because we always look at it annually, right? So $3,223 times 12, that brings you to $38,676 of your debt service. So now what do? We take the net operating income, we subtract the debt service out of it, and that gives us that cake, right? That gives us that cash flow before tax, which in this case would be $22,364, right? So this property is now being cash flow positive with $22,364. The next thing you're gonna calculate as an investor, which is the most important to me, is what's your cash on cash return, or we also call it return on your investment. So let's first figure out what the investment is. So we know you've purchased the property for $900. What was your initial down payment? $225,000. What was your second cost? Your closing cost. So let's say closing costs on average of, let's say, $33,750, plus, let's say you bought the property, you've done some paint, you renovated it, you spruced it up a bit, another $10,000. That's gonna bring you to your initial cash investment of $268,750. And what we have to do is, we have to take your cash flow before tax and divide it by your initial investment. So that's gonna be $22,364 as your cash flow before taxes, divided by your initial investment of $268,750, and that gives you your percentage, 8.3% return on your investment. You obviously have to multiply by 100, right? So here you have it, guys. In a nutshell, very simple formula, how you can actually analyze a property. How can you calculate in literally less than 10 minutes whether or not this is a good investment. This particular property is fabulous because it generates 8.3% cash on cash return on your initial investment, which is fabulous, right? Plus you owning 3 units, you cash flow positive, you always have a steady appreciation. Over here in New York City, we're looking at least 5 to 7% appreciation on a yearly basis. So if you purchase something for $900, the next year it's going to be probably $945,000, right? Which is always great. You got other tax benefits, but I don't want to go too deep. Today it's all about Poor Winds Eats Alt Nasty Dry Cake, how you can in less than 10 minutes figure out exactly what the property generating cash on cash return. Alrighty? Perfect. Hope you find it helpful. This is it for this particular video. Again, thank you very much for checking in. I really appreciate you coming back and checking out this content. Leave some comments below if you have more questions about investments and other formulas and whether or not this is clear or it's not clear, and we'll see you on the next one. Thank you.